We found two unusual trades, one of which is $14.2 million on Gilead Sciences stock, ticker symbol GILD. And what's also very unusual about this is that Gilead Sciences reports earnings next week on February 11th. And so in this video, we will analyze this unusual option activity to find out if these wealthy investors are bullish and buying Gilead Sciences before earnings or bearish and selling before earnings. Because as we all know, the rich have more access to information, including leaked insider information such as earnings reports, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into our analysis. Now, as we can see here from the charts, Gilead has been trading in this range for quite some time, and it was only until this day here that it started to break out to new highs today. And this day was actually January 24th, which was very unusual because on this day we detected unusual option activity and we shared it with our members in this email. As you can see here, January 24, these Gilead Sciences, GILD, these trades were going long bullish. The stock was trading at about $93.62. These options expire February 21st at the 95 strike calls, 4,500 contracts, and they paid a price of $209 each. And so if we take a look at those options now and how much they're worth, you can see here for these February 21st options, which we also got into the same position at the 95 strike calls. You can see here our position, POS stands for position, green means buy, where the value of these call options are now between $475 to $515. So that's more than 100% profit already, because we can now sell this back to the market for a lot more than what we got them for at 209. And when we take a look at the risk profile profit loss graph for these February 21st 95 strike calls that were only 209 each, you can see here on the profit loss graph that we have a profit of $287 per trade. And so if we do a quick calculation of the profit percentage of 287, divide by the initial cost of 209 times 100 for a percentage, you can see that it has made 137% profit so far. And so if you want to get trade alerts through email like the one we just showed, then make sure to go to our website. We'll put a link at the top here where you can gain access by joining our membership in order to get these better trade ideas. We don't always have time to make videos for every single unusual trade out there. And so by joining our membership on our website, you can get additional trade alerts emailed to you. Now, because we've made so much profit on this trade already, we started to update and manage our trade. And what we did was we started to roll our options. You can see here that we have a new position at the 102 strike calls. Because what we did was we started to take profits on our 95 strike calls, closing them out and rolling to this new position. And why did we roll into this position? Well, if we take a look at the data today, we can see on the options time and sales tape that there was 4,395 contracts being traded at the February 21st options at the 102 strike calls. And they were paying a price of $138. And so if we calculate the total trade cost of 138 times 4,395 contracts, we get a total of $606,000. But keep in mind, earnings is coming up. And so this is a higher risk trade in comparison to the trades that we share on our website. If you want access to lower risk, higher probability of profit trades, then make sure to go to our website.
Visit www.unusualoption.com to join our membership and start your journey to a financial success with a partner you can trust.
We will put a link at the top here where you can also learn trading strategies to further reduce risk while increasing the chance of profit. Now, with that said, let's analyze this trade some more. You can see these 102 strike calls where they paid 138 at the February 21st options. You can see that these 102 strike calls, they were also buying these for 138. And so when we analyze this trade, you can see that this trade is also a long bullish trade because the share price is on the x-axis here. As the share price goes up, this becomes more positive profitable because on the y-axis, this is the profit loss. And so the zero break-even line is here. And so when it is a negative, that is a loss because this is a long bullish trade. But keep in mind, because the cost of this trade of 138 is less than the amount of profits we already made from our previous trade at the 95 strike calls that we are rolling from, we are effectively in an earnings trade that will not be a negative loss anymore because we made about $287 of profit per trade. So we are locking in about 50% of the profits since this new trade costs only $138, half of our profits. And so that's the advantage of getting into these unusual trades early on before earnings is reported. Now let's analyze the second unusual trade that was much more significant. As we can see here on the options time and sales tape, at about 11:30, we can see multiple trades happening for these February 14 options at the 95 strike puts and the 103 strike calls. And we can add up these trades to get a total number of contracts. We have 500 plus 499 plus 499, which is 1,498 contracts. Now, if we take a look at the option chain for these February 14 options, we can see here that at the 95 strike puts, we have a volume much greater than the open interest of 79. So we know these are new opening trades. And also at the 103 strike calls, open interest only 9. And so we know both of these are new opening trades. And based on our analysis, that we're selling the 95 strike puts and buying the 103 strike calls. And so when we analyze this trade, you can see here that this trade is also a long bullish trade. As the share price goes up, this trade becomes more positive profitable. And if it goes down, it becomes more negative loss. But notice that the blue line is flat here, which represents the expiration, whereas the purple line represents the current date. And so you can see that the break even is all the way at about $95 because they sold the 95 strike puts. So this trade is hedged all the way to the $95 share price. And by selling these puts, they are willing to own 100 shares at this strike price. And so each contract required $9,500 of buying power. And since we know there was a total of 1,498 contracts, we multiply that out and we get a total trade that required $14.2 million. But as we mentioned earlier, this is still a higher risk trade because of earnings coming up. Anything can still happen. And so keep that in mind. And that is when we trade earnings, we use position sizing to manage our risk. And so if you want to learn more strategies to also reduce risk, or if you want to get access to the trades wealthy investors are trading for your portfolio diversification, then go to our website. We'll put a link at the top here because keep in mind, not all of these unusual trades will be profitable. Some may be a loss. But as long as we diversify with higher quality stock picks based on stronger data analysis, then we can become more profitable in the long term. Let us know in the comments below. Do you think Gilead Sciences will rally after earnings, or do you think it will crash back down? As usual, please hit the like button, subscribe if you haven't, take care, and have a wonderful day.